I like them if they're doing well. I think we found one here that has actually done pretty well. The big question, again, we don't know until we look at it. Is it a good buy going forward? And we're talking about the company that owns Chili's. Let me get to the right screen here. That company is Brinker International. Their symbol is EAT. I love that. EAT. Can't miss that one in the restaurant industry. Disappointed here. Shorts are 17%, so a lot of the shorts think this stock will fall. We do see they have a nice PE ratio, 18.1. I say nice because the industry's at 30.5. Price of sales, 1.3 versus 2.4. Price to book value, 18 versus 17. Price of cash flow is 10.2 versus 16.7. And the PEG ratio looking very good. It's 0.9 versus 18.5. So that's a positive there. Now, I can't believe these earnings. I mean, I'd want to look at the income statement because it shows that earnings per share change over last year up 145%. Either they had some big write-offs prior to that or something happened because the industry was only up 0.6%. The sales for Brinker International increased by 21.9 versus 4.2. That's a positive. The analysts, they give it a 5-year earnings per share growth estimate of 17.1% growth on the earnings per year versus 6.7. So this is looking pretty good. I thought for sure they paid dividend. No dividend paid.
Really?
Yeah, it's and I think they used to, and then now it's gone. The balance sheet, and again, I think they have franchises, I believe, don't they?
Yeah, I mean, that's the interesting thing. I was kind of looking that up. According to, again, ChatGPT, it's about 60 to 70% look to be company owned, actually.
And that's why the weak balance sheet, current ratio 0.3 versus 1.1 for the industry, and debt to equity is 4.6 versus 1. It's because they don't have a lot of assets on the balance sheet because they're a franchise. So
yeah, well, I really have. I don't know why I didn't think about this for so many years, but again, if you have a business and you're leasing it, right? I mean, frankly, our debt to equity for our company would be atrocious. Number one, we're asset light, but we have maybe giving too much. We still have a 7-year lease term. That would all be debt on our balance sheet.
Yeah.
To me, your lease is not really debt. It's almost like more of an expense in my mind because you're paying rent, right?
Right.
But the way that you carry it, it's debt for a lot of these companies. So I mean, if you look at Chili's and they have these lease obligations of multiple $1 billion, I mean, that could really skew that debt to equity ratio.
Yeah, and that's why you got to do the deep research to look at it and just understand the numbers. Because again, we always say people can repeat the numbers and say the numbers. You've got to understand what they mean, and that's why we try to do this is try to help you explain these things so that you don't get burned on something like, oh, I didn't know that. But the net profit margin looks okay for Brinkers. It's 7.1 versus 7.9. Return on equity, I think this shows they have a very low equity. I'm going to look at the balance sheet, I think, while you're looking at the earnings here. But the return on equity, 103%. So I bet you they have very low equity because, again, of the franchise model. And return on invested capital also is very good. That's 20.8. So, let me look at the, where did it go? The free cash flow, $414 million versus $2.9 billion. So that's okay. Depends what you got going forward, and I'll take a quick peek at the balance sheet if I can find it.
Yeah, I mean, I'll let you kind of pull that balance sheet up, but looking at the current price here, we'll have a further conversation around the balance sheet when you get it. But the current price for Brinker, again, their ticker symbol EAT, is $150.40. 52-week range, the low here is $68.45, and the high $192.22. I mean, the stock has just done phenomenally. Over the last 5 years, it's up 283%. So, if you're a big Chili's fan and you like going there and you bought the stock, congratulations. Also, too, they own, I guess, Maggiano's is the other one, but I think it's predominantly Chili's.
Is that? No,
I think a little Italian.
The Italian. I was thinking of Macaroni Grill, I think, is the other one I was thinking.
Yeah, no, I not that one.
Yeah.
But going forward to June 2027, estimated earnings per share here, $11.68. It will give you a target sell price of $193.88. So it's a little bit over 13 times the future earnings. That would probably put it in the hold category at these valuations, unfortunately.
Yeah, and I'm looking at the balance sheet, trying to get something out of here. I mean, you do have where the debt go? Long-term debt's $1.6 billion. Their total assets are about $2.6 billion, and they have very little cash. Property, plant, equipment's about $3.9 billion. So that is kind of surprising because for a franchise model, Well, I guess they only use about 30% of the restaurants.
Well, so here's the issue, right? I mean, it's like I've been saying, these leases. Well, so their long-term or their total liabilities as of June 2024 were last year. I can look at, looks like June 2025. Their total liabilities is $2.3 billion. $1.2 billion of that is capital leases.
Right.
So they have all their leases on the books. So again, like I'm going to use the Chili's here in Scripps Ranch. They don't own that. They're leasing that building.
Right.
So let's say they have a 10-year lease on it. That's 10 years worth of lease payments that you have to carry on your books as debt. That debt to equity might not be that bad if you actually then back out those capital leases.
And what surprised me too, as I said, is gross property, plant, and equipment as an asset's $3.9 billion. I didn't think it was going to be that high. So that's a positive.
They probably own some of the buildings.
Some of the buildings, probably a corporate office. Yeah, I mean that's quite a bit on the asset
And I just kick myself because we looked at this company during COVID.
I know I wasn't going to bring that up.
Yeah, but we didn't buy it because of the balance sheet. And
Yeah.
I don't know why we didn't think about the capital leases as, maybe not like real debt. It's kind of like when you look at a bank, right? I mean, their balance sheet's going to be skewed. Well, if you have a company that has a large amount of leases of buildings, I mean, I don't want to say you should totally disregard the debt to equity,
Right.
but you should understand that debt to equity, and you might be able to kind of actually come up with a more legitimate debt to equity by understanding what those leases look like.
Yeah. And again, we share that with our listeners because we want to let you know that investing's hard. It's not easy. It's not just throwing the dartboard and getting something. I mean, we said we made a mistake by not buying Brinker back during COVID because we're concerned on the balance sheet, but didn't really quite understand the franchise model.
I was going to say, not even the franchise, the company-owned model is the problem.
Yeah.
Yeah.
That's true. So
Potentially.
Potentially.